Good morning, everyone, and thanks for joining us today. My name is Giudici, and I'm responsible for the corporate project finance and infrastructure teams here at KBRA. Joining me is Joe Scott, who's responsible for our financial institutions team, Teri Seelig, who's our lead analyst on BDCs, and Madhur, who runs our corporate credit assessment team. Thanks, everyone, for joining. As many of you already know, KBRA has been extremely active in private credit. Our coverage includes 22 public and private business development company ratings, over 125 ratings backed by the collateral inside of private credit funds, 45 asset manager ratings, and over 75 ratings of middle market collateralized loan obligations. In addition, KBRA has developed more than 3,000 credit assessments of middle market companies that source loans from the various pillars of these private credit financings. Maybe just jumping right into it, Madhur, it might be helpful to get your thoughts on the impact rising rates will have on the credit performance of middle market companies. We've already seen rates rise around 500 basis points since March of 2022, but many are speculating that rates could rise another 50 to 150 basis points. If this were to occur, what do you think would happen to the default rates of many of the middle market companies that you're evaluating?
Yeah, thank you. Thanks, Andrew. I think this is an interesting question and one that we've looked at, closely. We recently published a research report, Middle Market Rate Stress, another 50 basis points, where we looked in depth exactly at this question on the portfolio of credits that we assessed. And I think that the answer really depends on the portion of the credit spectrum you're looking at. So for the typical credit that's in our portfolio, it sits in the lower and middle market space. It has an assessment of B-. It has a debt to EBITDA of about 6 times, revenue of about 150 to 160 million, and EBITDA of about 20. And I think what we found is that for these companies, the rate increases that we have seen already over the last year have already built in a reasonable amount of stress. In other words, about 15% of the regular credits in our portfolio we think have EBITDA levels that are not high enough to meet their expected interest expenses. This is without any further rate hikes. So I think that for these types of companies, further 50 to 150 basis point rate hikes, while not welcome, marginally will not be as impactful as the stresses that already exist in their financial performance. Now, 2 caveats here before I move on. First is liquidity matters. In other words, the cash that's sitting on their balance sheets really does help them address interest expenses. That 15% number reduces by about a third when we include cash on balance sheet as available to make the interest payments. So that's something that's worth keeping in mind. Managers who are going to be judiciously using that cash are probably going to be better positioned to deal with the higher rate environment. The second thing I would say is that our analysis doesn't really take into account any knock-on effects that might occur from higher rates in terms of their slowdown on top-line growth or contraction of EBITDA margins. And were that to occur, further rate hikes could be, again, more impactfully affecting the set of companies that we just spoke about. On the other hand, there are sort of higher rated companies, right? Companies that are rated in the double B space. These companies tend to have lower leverage and stronger EBITDA margins coming in. We think that these companies are better positioned so far for given the rate hikes, but that if rate hikes were to continue to occur, another 50 to 150 basis points might actually marginally be much more impactful on the balance sheets of those types of companies. So that's something it's a different story, and it's important to bear in mind that the credit spectrum really matters, and where you are on it probably places you in a different position today than you will be in 6 months from now. Finally, I'd say, just stepping back from this, right, for investors who are investing in KBRA-rated structures, be it funds or be it structured credit notes or ABS notes, we don't think that the levels of default and delinquencies that are going to occur in these portfolios will in general be large enough to create impairment stresses for the senior notes of these structures. And that's because many of these structures, actually all of these structures, already build into their credit enhancement, room for stress defaults. The CLO structured credit methodology explicitly also takes into account portfolio diversity or lack thereof in building in credit enhancement. And then on the fund side, they explicitly take into account manager skill and experience in dealing with an adverse economic environment. So the structures are already anticipating, more stress to fall environments and are building that subordination into them. And so we don't think that actual impairment risk will be, that the default and delinquencies will be large enough to actually create impairment risk for these notes.
Thanks, Madhur. Yeah, it's definitely going to be interesting to see how it all plays out. I think, one of the benefits of the private credit market is their ability to quickly negotiate a workout. Most of these companies that we've seen, they're relatively good companies and they have strong business positions. I just think some of them probably weren't underwritten in the current interest rate environment we're in. So I think, we will see workouts over time, and hopefully it's to keep these companies continue to operate as going concerns. Teri, might be a good time to kind of pivot over to BDCs. What trends are you seeing, and is there anything in particular that investors should be mindful of?
Thanks, Andrew. Yeah, I mean, the BDCs, they continue to benefit from increasing rates, right? And many have increased their base dividends during Q1, thinking that the high NII, net interest income will continue throughout the year. And that's basically because the loans are variable rate. They're floating rate and they get repriced. So the BDCs continue to benefit from that. And the BDCs raised a good portion of fixed rate funding during 20 and 21 in a very low interest rate environment. So spreads are high. They've also really benefited from the decline in the bank market and BSLs. So what we've seen is the BDCs have gone up market and they are lending to higher EBITDA companies in excess of 100 million. So that has definitely benefited BDCs, and we feel that also will help on the credit quality and the assumptions that they're building into their models now in the current environment is a slower economy and mixed economic forecasts. So leverage is lower. These are probably a very good quality vintage that are being underwritten today. Direct lending growth within BDCs has mostly come from the formation of newly created BDCs. And that's because BDCs maintain low leverage. If you look at non-bank financial institutions, BDCs maintain very low leverage, averaging 1 to 1.25 times, which will play to the strength in a weaker economy. And these BDCs, the newly created ones, are definitely benefiting from ramping up their portfolios in this favorable environment, both in loan pricing and terms.
Thanks, Teri. It's increasing rates have been favorable for the sector from an earnings perspective, but what about the credit quality of the portfolios, and how do you think they're being impacted there?
Yeah, so far we've seen minimal increases in non-accruals, very solid credit quality, and that's in place for now. And we do expect that we will not see any material increase in non-accruals in 2Q. But we have seen, and when we're talking to the issuers, there has been a drop in interest coverage, and that's obvious when base rates go from low 0 to 5% or so. So where they might have been 3 times interest coverage a year ago, in some cases have dropped below 2 times. But we're not that worried. We do think that PE firms are in discussion, the sponsors with the portfolio companies. They're working with them on operating costs. A lot of the BDCs, even prior to the pandemic, had positioned their portfolios in less cyclical sectors, a lot in software, high tech, that have a large variable costs, mission critical businesses. Many can pass the pricing on to their customer. And in discussions we've seen, especially in high tech, revenues still continue to grow, but at a much reduced rate. So there is room for operating efficiencies. And then the healthcare sector is another concentration of BDCs. And they have had more difficulties recovering from the pandemic. simply because of the higher labor costs and their inability to pass on higher costs. But we haven't really seen any concentration within any particular sector of non-accruals. Some things that you should consider when looking at BDCs is the vast majority of the loans are sponsored backed with very low LTVs. And the sponsored backed deals over history have generally performed much better. And as I mentioned before, these loans are, these companies are asset light, high EBITDAs in less cyclical industries. We've looked at the maturity walls of the portfolio companies within the BDCs, and we found that loan maturities through 2024 are only 6%, and going out to 2025, 10%. So there's less pressure to amend and extend these loans. If they do, what we are hearing is the BDCs have asked sponsors to put up more equity. And since they already have pretty high investment, they're not, we don't feel they're going to walk away. We've also looked at the portfolios to see where we might see pricing and there might be stress in the portfolio, and the amount of loans priced at 80 or below, which is kind of the threshold, is de minimis. We haven't seen any real uptick. So, while we think that the BDCs are definitely benefiting on the net interest income from rising rates, we do think that we will see some pressure in asset quality and that there could be an uptick in non-accruals in the coming months, but we don't believe it'll be material. We think that the BDCs are well positioned and have the capacity to, to absorb any, non-accruals.
Great. Thanks, Teri. It's encouraging to hear that they're well positioned and should be able to absorb losses if they were to occur. Joe, maybe just pivoting over, what are you seeing among private credit and private equity focused asset managers? Are you seeing similar trends as Teri is on the BDC side?
Yeah, I would say very similar. If you look at the portfolio company level, revenue, EBITDA growth continues at the vast majority of portfolio companies, although notably at a slower pace versus 2021, certainly. And this continued growth partially offsets the negative effect of rising interest rates on debt servicing capacity. And there's been very modest problems to date at the portfolio company level. That said, to echo some of Teri's comments, the PE sponsors are being very proactive with portfolio companies, especially those with potential issues, as interest rates remain high and the economy naturally faces continued headwinds. And these observations are based on our numerous conversations with the over 40 asset managers we rate. The vast majority of these managers are focused on private credit and/or private equity strategies. But notably, the managers themselves have taken a cautious view on interest rates, assuming higher rates for longer, and also with recessionary risk, they're generally underwriting to moderate to a more severe recessionary environment. So these cautious assumptions are being built into the underwriting of new investments, as well as the actions they take and potential actions they take on existing portfolio company investments. And then also notably, as Teri alluded to, the asset managers generally benefit from very durable fund structures, capital structures, and very sizable dry powder, which is committed but unused capital to offer potential support to portfolio companies in the event of need.
Thanks, Joe. There's been a lot of discussion on the credit quality of banks as well, and how's the quality of the loan portfolio of these institutions holding up?
Yeah, another very topical question. And the US banks, as many know, are just starting to report the second quarter results. And so far, the results are encouraging, especially when it comes to commercial and corporate loan portfolios. there hasn't been really any uptick in non-accruing loans in these portfolios so far. Outside of commercial and corporate loans, there's been a rise from a very low base in credit cards, in charge-offs there, and also CRE. As expected, office exposures have been an issue, but the good news for the industry is office exposures are generally a pretty modest percentage of the overall loan portfolios. But we'll have a much more comprehensive view on the banking sector when we host our upcoming bank webinar on August 3rd. In this webinar, we're going to cover credit portfolios, as well as an update on deposit trends, which is very topical, deposit pricing as well, any pressures on profitability, and then also capital management trends and the financial outlook for the rest of 2023. So definitely look forward to that.
Thanks, Joe. Looking forward to it as well. And at this time, we have received a few questions from the participants. As Caitlin mentioned at the start of the call, if you have any questions, please send them over through the Q&A feature at the bottom of your screen. Maybe just jumping into the first one. What is the willingness of PE sponsors to inject capital into their portfolio companies if there is some credit event?
Sure, that's a good question. You know, for the BDCs, I mentioned, you know, they're underwriting at low LTVs, so high investment from, you know, PE firms. You know, we rate, you know, BDCs that are part of a large credit platform and are dealing with high quality sponsors with sizable dry powder, as Joe had mentioned. So there is capital available to deploy. So we believe there is a good chance of support from sponsors, similar to what happened in 2020. And when we talk to issuers, if they are asking for, borrowers are asking to amend agreements, they are just in discussion with PE firms to put up more capital, and that seems to be the case.
Thanks, Teri. Yeah, I think that's similar trend that we've been seeing as well on the corporate side for the individual companies, where it really depends upon the company itself and their overall business plan. If good companies, they'll continue to support through equity injections. Companies that are in a different position right now, there may be a different decision to be made. So I think you're spot on, and a lot of it though is really going to depend upon the company itself. I think, as we mentioned earlier, many of these are good companies. They just weren't underwritten in a 12 to 14% interest rate environment. So trying to help these companies get through this time period is going to be critical. The next question we got: in this economic cycle, would you expect the loss given defaults to be higher than in previous cycles?
Yeah, that's an interesting question. I think from the BDCs that we rate are, as we mentioned, the much larger BDCs, and they are underwriting loans, mostly first lien senior secured loans. So, you know, more than 75% usually of the portfolio is first lien senior secured. Also, because they're part of a large platform, they have restructuring areas that have been doing this for years. So we do believe that there's a good chance that they'll be significantly lower, the defaults in this cycle.
Thanks. Anyone else want to add to that one?
Andrew. Hi, Andrew. Yeah, I thought I might add a couple of thoughts on, just to extend that point a little bit. I think in terms of LGDs, the answer probably depends upon which portion of the loan spectrum we're speaking to. Let's say to start with, we divide the world into broadly syndicated loans versus private credit space. Broadly syndicated space, I think people generally agree, tend to be larger companies, more highly levered, and tend to be covenant light, and often have several lenders that are on the same transaction. And I think these are all factors that in general people expect to lead to lower recoveries in an economic cycle downturn. And if you look at the research that's out there, the general acceptance is that loans this time around in the broadly syndicated loan space are going to recover 50 to 60 cents on the dollar, right? Those are going to be the ultimate recoveries. That's a lot lower than what loans have recovered in the past. Those numbers are more in the 75, 80 cents on the dollar space, right? So broadly syndicated loans, I think, are going to see lower recoveries. But I think in the private credit space, especially for lower middle market companies and middle market companies, we think that the capital structures were much more conservatively set up to begin with. And many of these companies actually have maintenance covenants like debt to EBITDA covenants, which I think give the opportunity for lenders to come in and negotiate a better situation for themselves if things turn down. And I think in general, especially for the smaller parts of this sector, there are just fewer lenders, and I think that makes it easier for them to negotiate more powerfully with their sponsors. So all those factors suggest to me that recoveries in private credit space would probably be higher than they will be in the broadly syndicated loan space. The one caveat I would add to this is that just the mix of companies is different, right? So the most of the companies that we see in this space tend to be asset-like companies. I'm thinking about software companies, right, and internet companies. And so one has to bear in mind the fact that on the one hand, the capital structures are stronger and the lenders are better positioned to have a constructive conversation around recovery. On the other hand, the asset itself might be more asset-like, and that's something to bear in mind.
Thanks, Madhur. There's a follow-up question on LGDs and whether or not it will be different by sectors compared to previous economic environments. I think you might have touched on that with the software sector, but do you see that going kind of broader than just that particular area?
I mean, yeah, I mean, another sector that again is asset light is sort of business and commercial professional services, right? It's a services driven sector. And so again, asset light. So that factor in and of itself probably suggests a lower recovery, but I would go back to say, probably going to be very case dependent. It probably depends upon the business strength of the company itself. It probably depends upon, the capital structure that was set up in the first place, how many lenders involved, how complicated the structure is. So many pieces have to get puzzled together to figure out what the recovery is. I think it's difficult to say, like sector by sector, these are going to be higher versus those are going to be lower. But the technology and commercial services sectors tend to be the two, which I think from an asset, valuation standpoint, may have some volatility around it. Yeah.
Thank you. Another question on the private credit market in Europe and how fast is it growing this year and beyond?
Yeah, and also another topical question, and we actually put out a detailed report on the European private credit market, which is available on our website. It was published in March 2023. But the private credit market in Europe generally is less developed than the US, but with very strong long-term growth prospects in our view. In the near-term growth has certainly slowed in assets under management in that space, but at the same time, it continues. I think a number of credit-focused managers in Europe are being opportunistic in raising funds, long duration funds, to take advantage of this better pricing environment that Teri alluded to. And at the same time, from what we hear, we rate 10 European asset managers, so we have good visibility here, is that the pricing in Europe is generally even better than in the US in terms of pricing, terms, and covenants. So that adds to the attractiveness long term. In terms of size, the European private credit, and this is based on third-party estimates, the market is approaching 400 billion in size, so far less developed than North America, which is approaching 900 billion in size. But therein lies the opportunity long term. I think as the European private credit providers were shown to be much more resilient in 2022 and so far in 2023 versus banks and the public markets, that really speaks to the long-term attractiveness of the market. And I think they'll continue to gain market share.
Thanks, Joe. Another question that has come in is, what are our thoughts on the performance of recurring revenue loans? Madhur, you might be on mute.
Thanks, Andrew. Let me try and address this question. It's a new sector which really hasn't gone through a cyclical downturn, if you will. And in fact, even in COVID, companies in this sector performed differently depending upon what the nature of the business really was. We saw many technology companies actually benefiting from that environment, while others might have been hurt. So I think the answer, as often is the case, is going to be that it's going to depend upon the business that this company is really in. How integral is this business to its customers? How sticky are the revenues? What are likely to be stressed churn rates, right? One of the things that I think really matters here. So recurring revenue companies, just for our listeners, tend to be companies that are from the software sector, technology sector, right? And they often are contractually based revenues. So that's where they get the revenues from. The business model is really set up on a high growth expectation from these revenues and the expectation that down the road, they will generate positive operating cash flow. And in the meantime, there will be sufficient liquidity either already on the balance sheet or through sponsors to get them there, right? So liquidity becomes a key part of this story. And I think that those recurring revenue companies who are able to maintain liquidity judiciously through an economic downturn, or are able to generate liquidity by doing cost cutting, maybe through various line items like sales and marketing expenditures or R&D, are likely to be the companies who are going to be able to come through a downturn and continue to perform well. So it's not that we should look at this entire sector as one big sort of lump of companies. I think the performance is going to vary a lot, and a lot of it is going to be about business model and manager attitude and conservatism.
Thanks, Madhur. I think we have time for about one more question. This topic seemed to have popped up on a few questions that have come in, is what are our thoughts on PIK features and how commonly are they being used in this current environment, given the underlying collateral and the business positions that they're in.
Sure, maybe Andrew, I can go here again. We're certainly seeing PIK features becoming more common in this environment. This tends to occur with the typical PIKs that we see either come about at origination itself. They tend to be 2 to 3 year PIKs before they come back to a regular pay structure. And sometimes they even come about when there is a covenant that needs to get negotiated, and as part of that negotiation, the loan is converted into a PIK loan. The covenant is potentially loosened. The loan may be extended, but in return, the lender says we really need an equity contribution from the sponsor. That tends to be the kind of conversation that occurs there. So yes, we are seeing more PIK loans at this time, and this is some of this is also just a reaction to we never expected rates to be where they are today.
Exactly. I think that's a common theme across the board. Well, thank you everybody for attending. It looks like we're running out of time and we still have questions coming in. We will be holding a series of these webinars to discuss trends in private credit. So we'll ensure that the questions that we haven't got to will definitely be addressed in the next one. Thanks again for attending, and we look forward to seeing everybody next time.